Welcome to Insightful Value, where we unpack overlooked opportunities hiding in plain sight. Today, we're diving into a company that's often flying under the radar, Goldman Sachs BDC. The stock price is low, but the yield is high. Is it a trap or a value investor's dream? This review is for informational and educational purposes only, not financial advice. Be sure to like the video and subscribe for more clear and concise value investing insights. Goldman Sachs BDC is a business development company, meaning it primarily lends to small and mid-sized private U.S. businesses. These are firms that don't typically have easy access to traditional capital markets, and BDCs like GSBD fill that financing gap. Goldman Sachs BDC stands out in this space thanks to the strong brand and institutional support from the Goldman Sachs platform. It focuses on senior secured debt, which is lower risk than subordinated loans, and spreads its portfolio across a range of industries to reduce concentration risk. Financially, Goldman Sachs BDC currently trades well below its net asset value per share, which may offer an opportunity for conservative value investors. Its dividend yield is currently attractive, sitting above 10%, and management has kept payouts relatively consistent over the years. Earnings have been stable, but like many BDCs, GSBD is sensitive to interest rates and economic cycles. Higher rates boost interest income on its floating rate loans, but also increase the risk of borrower defaults. So there's a balance to watch. In the latest quarterly report, GSBD showed continued portfolio growth and relatively low non-accruals, which means most borrowers are still paying. Net investment income covered the dividend, a good sign of sustainability. However, credit quality remains a key risk, especially if the economy weakens. The firm's operating expenses are slightly on the higher side compared to peers, due in part to the Goldman Sachs infrastructure, but this is also what enables better deal sourcing and risk management. From a value analysis perspective, the discount to book value and consistent dividend could appeal to income-oriented investors who are comfortable with the risks tied to private credit markets. The current stock price seems to reflect market skepticism about future growth and potential credit losses. But if those risks don't materialize, there's room for upside. The firm also has a history of small dividend adjustments based on earnings rather than large swings, which makes it somewhat predictable from an income perspective. Dividend-wise, GSBD has paid consistently since going public, and while it's not growing rapidly, it's been reliable. The firm occasionally issues special dividends when earnings exceed the regular payout, adding potential bonus income. Given the current yield and market discount, some investors might see this as a rare opportunity for both income and capital appreciation. That said, it's not without risk, especially in a credit tightening environment. Will the stock price recover soon? That depends heavily on the macro environment. If we see stability in interest rates and no major uptick in defaults, the market might re-rate the stock closer to its book value. But if recession fears escalate, BDCs like GSBD could face renewed pressure. At Insightful Value, we break down complex data into straightforward insights so you can make smarter decisions. Whether you're a dividend hunter or a long-term value investor, we help you find ideas others miss. More info about this and other companies is available at insightfulvalue.com. If you enjoyed this breakdown, hit that subscribe button and give us a like. For more undervalued company insights and clean analysis, visit insightfulvalue.com.